like Tomi, Eniola, everybody that worked together to make sure that this training happens. I'm really thankful to you guys. Thank you for the good work that you are doing for Kalido Foundation. And I also want to say thank you to everybody that is participating today. I know that you are all here to learn, but I'm still thankful that you even took us serious enough to believe that we have something to say that you can learn from, right? So thank you. I would want that as you have questions, as questions come up, to you, either put them down or just put them in the chat box so that when I'm done, we'll go straight away to the questions. I don't want to miss out on anybody's questions. And yeah. Okay. So today we're going to be talking about investment banking. And I'm going to be, apart from like talking about the technicals, I'm also going to be, my team, they know me. I always try to infuse my experience into everything I'm talking about so that I can make it as relatable as possible. I want to confirm that I'm very clear and you can hear me well. So if you can hear me well, just give me a thumbs up so that I'm sure that we're on the same page. Okay, good. Thank you. So prior to me, a little bit of my background, I studied banking and finance at Babcock University. And while I was in the university, I just knew there was something called investment banking, right? I wanted to be an investment banker, but I didn't really know what it entailed. I didn't really know, like the different areas of investment banking and which one I would actually want to specialize in. I just knew, oh, I want to be an investment banker. I want to be an investment banker. And I suppose as God would have it, before then, what I also did while I was in Babcock was to start my ICANN exams. So I basically did my ICANN alongside my banking and finance course, so that by the time I was done with school, I was also a chartered accountant, right? And then I got a job at a bank, and somehow I ended up in the investment banking units of that bank. I'm not going to say that I actively looked for that role, or I actively made sure I got into that role, because as I later, would find out, when you're working in a bank, or let me say maybe banks in Nigeria, especially at the entry level, they don't really care about what you study in school. If you study Greek, if you study, nutrition, anything you study at that entry level, they just bring you in and either put you in marketing or put you anywhere. They don't really care about your specification at that level, right? So for me to have found myself in investment banking, I just want to believe that, there's a higher power that was working to make that happen. And so I'm going to be sharing with you my experience as an investment banker during that period. So what I found out was investment banking, the unit was called investment banking units. But under investment banking, as you would find out during the course of my presentation, there was the corporate finance department under investment banking. There was treasury as another unit under investment banking. And then there was financial institutions, or let me say wealth management. So corporate finance, treasury, and wealth management. And then there was risk management. So those are the 4 areas that we're going to be talking about. But you see, under those 4 areas, there's still so much, there's still so many areas of specialization, even under those 4 units. And I'm going to try my very, very, very best to enlighten us about the different specializations, so that for you guys, I'm assuming that you guys are studying banking and finance or accounting or something related to that at the moment, and that you are interested in investment banking. And my goal today really is just to try and help you understand which area of investment banking you would want to specialize in. So we're going to start off with corporate finance. As a way of introduction, I've already said investment banking is just a specialized branch of banking that helps companies, governments, institutions to raise capital and also execute large-scale financial transactions. So that's really what investment banking is about, is broad, okay? It involves issuing of capital, and when you are issuing capital, you can either issue it as debt or issue it as equity. It also involves helping clients with mergers and acquisitions. It involves providing advisory services, and honestly, a whole lot of other things. So, okay. Corporate finance, yeah. So we'll start with corporate finance. Corporate finance is one branch of investment banking. And as a matter of fact, when I joined the investment banking unit, I started in the corporate finance department. So I'm just going to be telling you about my experience and use that to bring home what I'm trying to talk about. In corporate finance, what we used to do then prior to 2008 was we had clients who were looking for money, trying to raise capital, but they didn't just want to take loans from the bank. So what we would do for them was either help them raise capital through equity. And when you're raising capital through equity, you can either do that by issuing shares through something we call an IPO, initial public offering, or initial public offer, meaning that you are inviting the entire public to buy your shares, buy shares in your company, basically. And this is open to everybody, both individuals, institutions, corporations. Anybody can, partake in an initial public offering. So that's one way that companies raise capital. And then some other companies will say they don't want an initial public offer. They want to do maybe a right issue. Right issue means sure they've done an initial public offering or an initial public offer in the past. So now what they just want to do is get those shareholders to buy more shares in the company. So that offer or that transaction will only be open to existing shareholders of the company. So they will ask them to buy more and, bring in money. So what it means is that the investors will be investing more money into those companies. So that is called a rights issue. I'm sure some of you will be familiar with these terms. And then there's also something called a private placement. Private placement means that we don't want to open this offer or this transaction to the entire public. We just want a specific set of people. There are different criteria to choose the type of people. It could be that maybe they want people that have the power to invest maybe 100 million and above. They don't want anybody that does not have up to 100 million to invest in that transaction. There are different criteria you can use, but the bottom line is it's a private placement. It's not open to everybody, just a select group of people, right? And then sometimes corporate finance also involves transactions that we call equity derivatives and structured products. It could come in any form. It's under investment banking, or would I say under corporate finance, the ways through which you can raise capital is different. Like there are no particular structures that are fixed. The structures are not fixed. You can come up with anything. I've seen so many variants of transactions that you can do, and there's no law stopping you from doing it. So there are things we call equity derivatives, and they are a bit, too complex. So I will not really go into them. But there are things we call derivatives. That's just what I want to. It could be that. So for instance, I don't know how many of you are familiar with maybe the commodities markets. So sometimes a company can say, okay, I want to raise capital such that it will be linked to the equities markets. Maybe the price, it could be that the price will be linked to the equities market. I saw one recently. A state government was trying to raise funds recently. I'm not even sure if the offer has closed. They were trying to raise funds, not through equity, by issuing a bond. They now said the pricing of that bond will be such that it will not be fixed. So it's not like they are selling a bond that's maybe 20%. They are now saying, even if we sell this bond to you at 20%, to determine the interest that will be paying you on this bond, it would be dependent on where other government securities of that tenor. Let's say the bond is a 10-year bond. So at every point in time when they want to pay interest, if the bond has maybe in 1 year time, that bond that will become a 9 years bond. So they will now go and look for another 9-year bond in the markets, in the secondary markets. I will explain what a secondary market is later. So they will look for a federal government 9-year bond, and wherever that bond is trading in the market, that's what they will use to determine the interest that they will pay on their own bond. I think it was Cross River State. So you can come up with different things as long as it's, suits what you are trying to do. So that's what I remember then. We used to have clients, different clients. It could even be a restaurant. It could be Mama Cass. It could be anybody will come and be like, okay, we want to raise, maybe do private placement or do public offer. So your role as a corporate finance person is to say, these are the requirements by maybe Securities and Exchange Commission for you as a company to be able to raise money from the capital markets, from the equities markets. These are the criteria that you will need to meet, because we'll need to get SEC approval. So your role as a corporate finance person in those type of transactions is to let the customer know what the requirements are, let the customer know how long it will be, so timelines for the transaction. And then it is your role to also determine based on the valuation of the company. What I mean by valuation is how known are they? Are they a big company that everybody knows? There are some companies we call blue chip companies. Coca-Cola is a blue chip company. MTN is a blue chip company. Airtel, Mobile, all those companies are blue chip companies. But a Mama Cass may not be a blue chip company. Mr. Biggs may not be a blue chip company. So the pricing of that transaction would depend on how credible, how people view that company to be, how their net worth, something like that, how big people think the company is. So that's what you use to determine the price. Because the truth is, an MTN, for instance, because they are a blue chip company, will be able to raise money at a cheaper rate than a Mama Cass. So it is your role as a corporate finance person to be able to advise your customer accordingly. And then there's something called valuation. You have to know how to do valuation. You have to know how to work with financial models. You have to have strong analytical capabilities to understand the transaction, what the customer is trying to do. Because if that transaction should fail, that failure, more often than not, will be blamed on you as a corporate finance person, because it will be believed that you did not advise your customer well. So it is also your job to have knowledge of market trends and regulatory frameworks so that you can ensure that your customer meets all the requirements to enter into, to do that transaction, right? So that's what corporate finance entails. And all of these things, these skills I'm talking about, it applies to both the equities market and the debt markets. Remember, I've said that under corporate finance, your customer can raise funds either through equity or debt. So irrespective of whatever the model is that they are using, you need to know all of these things, right? The debt market as well, it just means that instead of the company raising capital through equity, you can also advise them to raise capital through debt. But what I know is that sometimes whether a company, the determinants of if a company will raise money through equity or debt is also dependent on maybe before now, they've already raised money from the debt market, right? So they feel like going back to raise more money may raise eyebrows or questions. So instead of going through debt, they will now say, okay, let's do equity. Sometimes a customer would have gotten to their limits for taking loans from banks. Maybe they've taken loans, they've not repaid, and the banks are already saying, we cannot give you more money. So what do? They will say, okay, what other type of debts can I raise? That's where you will see some customers coming into the market to raise money through commercial papers. There's something called commercial papers. It's a money market instrument. I don't know if you are aware of it, but essentially what it means is that the company is trying to raise funds from the market through a commercial paper. A commercial paper works like a treasury bill, where the company is just essentially saying that I'm going to sell you a commercial paper of maybe 180 days or 270 days or 364 days. You give me your money, I will give you this commercial paper certificate stating that I took money from you at 20% and I'm going to pay you back in 180 days or in 270 days. So that's just what it means. So there are some companies that issue money through commercial paper, sometimes because it will be cheaper than taking a bank loan, and sometimes it could be because they've reached their limits of for taking loans from the banks, and so they will come to the direct public to come and raise funds. So that's what the debt market is just raising funds through government bonds or treasury bills or other debt instruments, right? Yeah. And also, like I said, for the equity, you need expertise in bond valuation so that you can determine what price that bond or that commercial paper, where it should be priced, that customers will be okay to buy it. You need expertise in credit analysis. You need expertise in credit analysis because you have to be able to look at a company's books, their statement, their annual returns, and analyze their annual returns, their end of year accounts. Is the company making money? Is the company over leveraged? Do they have too many loans in the market? And the reason why, as a corporate finance person, you need to know all these things is because there are some investors, both individual investors and corporate investors, institutional investors. They too, they have people that know how to do this analysis. So when you bring a customer to the market and say that the customer wants to sell commercial papers at 25%, those companies and some individual investors, they will go and look for, remember that when companies conclude their end of year accounts, they make it public. So those documents are available for public consumption. So they too will go, as a matter of fact, when you are even issuing a bond, when your customer is issuing a bond or a commercial paper, you have to even attach those documents. You attach all those companies' documents in the email when you're sending it out to all your customers. So they too can open it and do the analysis and determine whether the price of that transaction makes sense. That's why before it gets to that level, you must have done the analysis. You must have advised your customer appropriately so that it will now not be when the offer is in the market, then customers will now come and be attacking you that no, this price is not okay. We cannot buy it because this price is not okay. You don't want that to happen because you would then have issues with your own clients. So you also have to understand macroeconomic factors that impact interest rates, right? So if, for instance, inflation is very high, like right now, inflation is above 30%. So inflation cannot be at 30%, and you'll be telling your customer to issue a commercial paper or a bond at 15%. Nobody will buy it because 15% is too low. Even if the company is a blue chip company, nobody is going to buy a bond from anybody right now at 15%. So that's why you need to understand how things like inflation, exchange rates, monetary policy rates, and so many other things, even rates in the international markets, in the global markets, you need to understand how all of those things affect interest rates, because it will affect the price that you are going to advise your customer to issue those commercial papers at. You also need to have very good negotiation and deal structuring skills. Why? There are sometimes, like I told you, that some customers, they don't want to make their transaction open to the public. So sometimes they may just say, you know what, you are my advice, you are my investment advisor, you are my financial advisor. You go and bring 10 institutional investors to the table. Bring them to the table. Let's have a conversation with them. Let's see if they can, among the 10 of them, if they can help us, give us the money that we're looking for. But your customer will need you to have good negotiation and structuring skills, because when those 10 people come, they will want to try to take advantage of the customer. You are the one that will need to be able to help your customer negotiate terms and conditions that will be favorable to your customer, or at least even if they are not very favorable, they will not kill the customer's business. That's your own job. So these are the skills you need to have as a corporate finance person trying to help your customer to raise funds, or apart from raising funds, even leave raising funds. When you have a customer, as a banker, when you have a customer, even if you are just a marketer, your job, the way you see your responsibilities to that customer should go beyond, oh, okay, when the customer comes to bank, if they need cash, I will help them get cash. And if they want to get a loan, I will help them get a loan. Your job goes beyond that. Your job is, you want to see your customer thrive. You want to see your customer do well. You want to see your customer's business. You want to see it, thriving. You want the business to last. It's almost as if you are the owner of the business. That's how you should take your customer's business, which is why it is very important that every day you are on the job, every day you come to the office, you are coming with the mindset that I want to give my customer the best service. I want to do the best for my customer. I want to get my customer the best deals. And that's how you need to see yourself as a corporate finance person. So recapping, corporate finance is helping customers raise capital, either through equity or through debt. That's what corporate finance is. So now treasury. Treasury, after a few years in corporate finance, I was moved to treasury. So I have also had the opportunity of working in treasury. So I'm going to explain it to you based on experience, right? So in treasury, you find, so as against corporate finance, where you are working for your customer, basically, when you are in treasury, you are actually working for the company. So if it is a bank, let's say maybe Zenith Bank, for instance, and you are working in Zenith Bank Treasury, your job in Zenith Bank Treasury is to help Zenith Bank make the best use of their money, the best use of their capital, right? So this one is, even though in treasury you deal with clients, so it's not like you don't deal with clients, you will deal with clients, but your role is to help the customer make the best, the bank, the company you are working for, make the best use of their money, right? And in treasury is divided into assets and liability management, which is like liquidity management. So there's a liquidity management desk, or an asset and liability management desk, more like. We call it ALM, assets and liability management. Then there's also the trading desks. And by trading, I mean, in treasury, you have the FX desk, that's the foreign exchange desk. And then you also have the fixed income desk. Now, this is for a bank, because I worked in a bank. But if you are, most companies, a lot of companies have treasury units, right? But what the treasury in that company will do is dependent on the type of business that that company does. So let's take, for instance, flour mills. Flour mills may not have a trading desk. they may only have the asset and liability management desk. Why? Because the work they do is to sell flour. But in selling that flour, they have to import materials, right? So in importing materials, they need FX. So they may have a foreign exchange desk for the purpose of helping them get FX. But also they can say that the asset and liability management desk should handle everything, should handle the FX, handle the monies that are coming in from their distributors, or they produce or they manufacture flour and then they sell flour. So that means money comes in from customers and money goes out to suppliers. So they may only have the asset and liability management desk to manage the process of money coming in and money going out, right? But for a bank, as a matter of fact, some companies, even flour mills, maybe Nestle, I remember then, Nestle used to invest in treasury bills. So even though they also import and sell, but they also used to, some of their profits, they used to invest it in other assets like treasury bills and bonds and things like that. So Nestle, for instance, even though they may do almost the same thing as maybe a Cadbury or a Nigerian, no, not Nigerian Brew, it's Cadbury, right? But if Cadbury, for instance, does not invest any of their money in things like fixed deposits or treasury bills, they may not have a fixed income desk. They may just have an ALM desk. So I guess what I'm trying to say is that it is not compulsory that in treasury you will have FX, fixed income, and assets and liability management. Some people can have just two of it. Some people can have just, some people's treasury can have just one of those desks. Some can have three of them. So really, and the honest truth is, sometimes ALM can actually handle everything. But for banks, they split it. So there's ALM, and what ALM basically focuses on is just funding. And the job of, I remember then, every morning when we get to work, the idea is that if you are on fixed income traders are always looking for money to trade. They trade fixed income in the secondary markets. Remember, I told you I was going to tell you about secondary market later. So there's something called the capital markets. The capital market is a market where all of these things happen. Investment banking is in the capital markets. The capital market is where everything financial takes place, right? The capital market is where corporate finance happens, and so on and so forth, right? So there's, in the capital market, there's something called the primary markets and then the secondary markets. Primary markets is where new issues, so for instance, when you are doing an initial public offer, is a new issue. You are selling new shares, fresh shares, is new, is being done for the first time. That is done in the primary markets. If that's for equities, also for debts, if the government wants to issue new treasury bills, new for the first time, they are issuing it for the first time, or a bond, and they are issuing it for the first time, it's usually done in the primary market. The primary market is not a place, actually. You cannot go, there's no physical location called the primary market, but it just refers to when you are doing something new for the first time. However, there's a secondary market where all the new issues. The new issues are only new for one day, only for that day that they are done for the first time. From the second day, they become secondary markets. And what happens in the secondary markets is that banks and some institutions, they trade all these instruments in the secondary markets. I don't know if I can explain it very well. So bonds are being traded actively. There's a secondary market for bonds. Okay, I think the best way to understand it, that I can explain it, is just to say that anybody that buys from the primary markets can go to the so you can buy a bond today in the primary markets, and in 1 week time you can decide that I want my money back. I don't want to hold this bond anymore. The secondary market exists for that purpose, for you to be able to sell your bond, even if it is. So the bond can be a 10-year bond, it can be a 5-year bond, but you can sell it 1 week after you buy it. That can be done in the secondary market. So there's a secondary market for treasury bills. There's a secondary market for bonds. There's a secondary market for equities. So if you hear, oh, equities are trading every day, equities, the price of equities are going up and down, and the equities market went up today, or the equities market went down today, the bond market went up today, the bond market went down today, is all in the secondary markets. And what the secondary market does is that it makes these instruments liquid. Liquid means that's why when they teach you in school that there's something called liquid assets and assets that are not liquid. The liquid assets are only liquid because a market exists where you can buy and sell as you want. It doesn't mean that every time you buy and sell, you make profit though. You may not make profits, but at least you can get your cash back as soon as you want it. So maybe if an emergency comes up, you have a treasury bill, you need money quickly, you can go to that secondary market and sell. You may make a loss, so maybe you bought at 10 naira. You may not be able to sell at 11 naira. Maybe you will be able to sell at that 10 naira, or you can sell at 9 naira or 8 naira. So you might make a loss, but at least you will get some of your money back, or most of your money, you will get it back. That's what the secondary market exists for. So back to treasury, assets and liability. So if you desire to work in treasury, you can either work as an asset and liability person, or you can choose to be a trader. You can choose to trade fixed income instruments for the bank or for the company, or you can choose to trade foreign exchange for the bank. So those are the different roles that exist in treasury. I won't say more than that because of time. Yes, liquidity, this is what I've said. There's liquidity management, funding and capital management. All those are under ALM. There's risk management, there's cash and asset management. All those are fixed income, basically. Now, wealth management. Wealth management is, how do I put it? Wealth management focuses on helping high net worth individuals maximize their wealth. That's what wealth management is about. It's almost like corporate finance. But for corporate finance, your clients are corporates. Your clients are not individuals. They are corporate bodies. They are companies, right? And under corporate finance, I forgot to mention, it is not only equities and debts that you can get well, yeah, it's also under debt. I think it's under debt. Under debt, it is not only bonds that you can do for the customer. You can help them do structured products, like I mentioned. You can even help them get just deposits. Simple deposits. Sometimes, if you are able to package your customer very well, the company, you can even package them to access funding from abroad. That's part of your work. Maybe they don't want to, maybe they want to borrow, especially for companies that always need foreign currency, like the flour mills that we talked about. You might say that maybe flour mills, because of depreciation and all that happening in Nigeria, they may say, we want to raise foreign currency. As a corporate finance person, you are the one that would advise them to say, okay, if you want to raise foreign currency, we know people that we can pitch you to, but it is you as a corporate finance person that will put that pitch together. You are the one that will do the presentation, how you will pitch them, how you will package them in a good light, so that the investors abroad, would see them as a good prospect, basically. So you are the one that will know the documents that they need to put together, how they would need to explain themselves in a good light. You are the one, it is your job to advise them on the documents to put together, on what to say when those meetings happen and things like that. So that's also that. But wealth management is mostly focused on individuals, high net worth individuals, people that have maybe 50 million, but they want to grow that 50 million to 1 billion. People that have 100 million, but they want to grow that 100 million to billions. So you as a wealth manager, your role is to have knowledge of different types of investments that your customers can put their money into. You are the one that will help them with portfolio management. You are the one that will advise them on, oh, if you have 100 million, don't put this 100 million into just one thing, right? You are the one that will advise them that maybe let's do 40, 40, 20, 30, 30, 40, put 30% in a low risk investment, put another 30% in a medium risk investment. I hope we know what low risk, medium risk, and high risk, what it means. I will explain briefly. Low risk means that you are advising the customer to put their money in investments that the risk is very, very low. So things like government securities, people always believe that government securities are secure because the government will pay you back. So things like treasury bills, bonds, people see them as low risk. So you can advise your customer, but more often than not, low risk also means that the interest that the customer will get on those investments will not be too high. That's technically, that is what it is supposed to mean, even though right now as we speak, government securities the rates are very high, right, at the moment. But typically, low, I don't know if you've heard the term, the higher the risk, the higher the reward. The lower the risk, the lower the reward, right? So low risk ordinarily means lower reward. Medium risk is a mixture. Of, so medium risk could be putting your money in an instrument that is issued by a blue chip company. So yes, the company is not owned by the government, so it is not a low risk investment, but you know that, okay, this is a blue chip company, so you are almost certain that the customer will not lose their money, right? But you and me, we both know that anything can happen. MTN can carry their bag and say they are not, they don't want to work in Nigeria anymore. They are leaving Nigeria. I mean, in the past couple of years, I don't know how conversant you are with things that are happening in the economy. Some companies have shut down and said they don't want to operate in Nigeria anymore. You know, some companies have gone under, you know, I'm sure you know what bankruptcy means. Companies go bankrupt all the time, right? But on the surface of it, you more often than not, you say, okay, a blue chip company, Mobile cannot run away, you know, and things like that. So you can advise your company, put your money in a Coca-Cola, you know, put your money in MTN. Those ones you might say, okay, they are. I'm not saying buy shares of MTN or buy shares of Mobile. I'm saying maybe if Mobile is issuing a commercial paper or they are issuing a bond, they are issuing a bond, maybe a 10-year bond, and you tell your customer to buy. That can be seen as a medium risk instrument. High risk is telling your customer to buy shares because the equity market is can be volatile. Today, the price goes up. Today, the price goes down. Sometimes you can buy an equity, you can buy a stock or shares of a company. And after you buy, the price just goes down. And the price can be down for months or even years. The only good part of it is that if you buy the shares of a company that pays good dividends, so at least your customer will be getting dividend, they may be getting dividend, but they may not be able to sell, except they sell at a loss. They may not be able to sell. So the onus is on you to advise your customer appropriately. You are the one that you may not be the one that will advise them to say, buy these shares. But as a wealth manager, it is your job to say, let me get a good stockbroker that will advise my customer. So you don't have to know everything, basically. Both in corporate finance, in all of these things, you don't have to know everything. But you need to know where to go to get your customer the right service. So if you are in corporate finance, but you don't really know how to do valuation, for instance, it is your job to find somebody that knows how to do valuation very well and tell them to help your customer to do the valuation. So I'm not saying that you need to know everything by yourself. It's good to always have an idea, but you may not necessarily know everything, but you need to know where to go. So if your customer has never bought shares before, but you know that through shares, they can make money, it is your job to say, to get a stockbroker or an educated person to teach them about stocks and help them go about, you know, opening a stockbroking account and all of those things. So your job as a wealth management person does not stop at only what maybe your company offers. No. You need to be able to go above and beyond to tell to get your customers a variety of investment products, right? So that they can have a well-diversified portfolio. Diversification means that all of their money is not tied into one thing, so that peradventure they buy a stock and that stock is not doing well. It doesn't mean that the customer will not be able to eat. If they bought treasury bills, for instance, and the treasury bills is giving them interest, while the stocks portfolio is down, at least they will still be making money from the treasury bills. So it is your job to find your customer tailored investment products that will help them, grow their money. It is your job to give them the right financial advice and the right investment strategies for their wealth, building. Let me put it that way. Okay. And the idea is that they are coming to you to help them achieve their financial goals and to help them meet their long-term growth of their wealth. It is your job to help them do all of those things. Okay, so I've talked about all of this: assets allocation and diversification. Those are the focus areas of wealth management. Tax planning and retirement planning. It is also your job to help them with that, to let them understand that if you invest in treasury bills, this is the tax that is applicable to treasury bills. If you invest in, which is I think now, before there was no tax on treasury bills. I think now there's withholding tax. I'm not sure, but I think there's withholding tax now. If it is VAT, you need to let them know that you are going to pay VAT on this. If it is a bond, you need to let them know what tax is applicable if they buy a bond. If it is shares, you need to let them know, oh, you may pay capital gains tax. So you must know all the tax application, right? Retirement planning, it is your job to also know how to help them. If a 25-year-old person comes to you and says, I need your help, I want to plan for my retirement, advise me on how to go up. So that's why under wealth management, sometimes you will see a wealth manager that can have a client for 20 years, 30 years. That person will remain as your client, because the idea is that you are working with them throughout their lives to help them achieve their wealth goals, right? It is your job to help them grow their wealth and preserve their capital. So unlike corporate finance, like I've said before, wealth management is relationship driven and focuses on individual client needs, not corporate. Corporate is a corporate finance. That's why it's called corporate finance, right? So I've talked about this. You profile your clients, understand their risk tolerance. Some customers don't have mind for high risk instruments. So for those type of customers, you don't force them. Over time, they may change their mind, but you don't force them. Just understand their risk tolerance and advise them on investments that are within their risk acceptance criteria, right? Strategy development, asset allocation, diversification. There's also something called incorporation of ESG factors and modern trends. There are some customers, they can tell you that, oh, they care about the earth. They care about global warming. They only want to invest in instruments that, like I told you, under investment banking, there are so many things that, especially when you get to the level of commodities trading, people can trade air, the air that we breathe. Some people trade it. There's nothing that is not traded in investment banking in the world. People trade differently. So a customer can tell you that it is only, or they can tell you that if they want to buy shares, they only want to buy shares of companies that focus on improving the environment. So they only want to invest in maybe companies that are that do good CSR. So before they put their money in that company's shares, they will tell you that you should convince them, show them that truly, this company, they pay attention to the environment, they don't contribute to carbon emission, they don't contribute to global warming issues, that if, you know, the company violates any of those things, that they cannot put their money there. And that's why I don't know how much you know about things like maybe in China. I don't know if you've heard of some companies, that American companies, that have taken their production of maybe clothes. They may be fashion stores in the US, but the production of their clothes and everything they sell is done in China. Then maybe one news will now come out that, oh, they use underage workers in their factory in China, or that they are what's this thing called? They are into child trafficking. They are into child trafficking. Immediately that news gets out, you will realize that their stocks, their stock price, the stock price of those companies in the equities markets, it can start dropping. People will start selling their shares. People will start dumping their shares just because of that news that came out. It happens. So all of these things matter. Some customers are very, very sensitive to things like the environment, how the company that is holding their money, how those companies treat the environment, treat people, and things like that. It is also your job as a wealth manager to keep on monitoring your customers' portfolio. You don't just say because today they've come and you've helped them to allocate 100 million, so that's the end. No, you have to keep on doing performance reviews of the portfolio. Maybe, for instance, if you are here, maybe you advised them to buy the shares of maybe Dunlop. You know, Dunlop has left Nigeria. I don't know if they came back. Maybe they bought Dunlop shares, for instance. And then you are now hearing news that are maybe because of FX issues and things like that, customers are leaving the country. You have to go and look for information. Start asking questions. Which companies are leaving the country? Which companies are having issues? Which companies are having FX issues? So that if that news is not yet public in the markets, but you have gotten that news, you can quickly come and tell your customer to call their stockbroker, quick. Tell their stockbroker to sell that shares before the news becomes public, because once the news becomes public, the price of those shares will drop further and your customer will make a serious loss. So it is your job to always put your ears to the ground, to have that information so that you can advise your customers appropriately, right? And help them to rebalance their portfolio, help them adapt their portfolio to market changes. Because the reality is that every policy that the government rolls out always affects companies differently. It can favor one company and it can affect another company negatively. So it is your job to ensure that however a policy is going to affect any company, it must not affect your customers' investments, right? That's the job of a wealth manager. Technology and innovation. So for instance, maybe before your customer was having to maybe go to the bank. Anytime they want to buy treasury bills, they have to enter the bank. Immediately you realize that maybe some companies have developed apps. So customers can buy the treasury bills on the apps. They can do fixed deposits on the apps. They can even trade stocks by themselves through an app. It's your responsibility to advise your customers to say, ma, sir, do you want to start using the app, or do you want to continue doing it the old-fashioned way? Give them the option. Let them choose. whether they want to continue the old-fashioned way or they want to step up, you know, and start using technology. So all of those things are your responsibility. Now, risk management. The reality is that risk management is not really investment banking per se. But because everything done in investment banking is risky, all these things I've told you about now, price volatility that affects stocks, affects interest rates, things like inflation. The truth is, based on my experience, investment bankers are they are risk prone. Most of the investment bankers, I know, most of the traders, treasury traders that I know, they like risk. They embrace risk, right? They love doing risky investments. Why? Because what did I say before? The higher the risk, the higher the return. So it is that return that they're always looking at. Investment bankers like risk. I don't know how many, if you've ever heard about some banks abroad that maybe they are traders, some banks that went under, or maybe they are traders over traded, or their traders did some things and the bank lost a lot of money. There are some traders that can hide trades. They can hide trades. They can do things. Maybe those things will now be in loss. They will now do other things to cover the loss that, you know, their bosses will not know for the longest time, because traders always believe that they can cover the loss. Maybe within 1 week or within 2 weeks, they will say they will trade more, they will do this, they will do, maybe the markets will go back up, maybe the markets will go back down. That's how traders are. So if there is no risk management structure, if a company does not have good risk management structure in place, monitoring what traders are doing, monitoring what investment bankers are doing, there can be problem. That bank can go down. That bank can lose money. That company can go under if there is no risk management backing everything that treasury and corporate finance are doing. The bank or the company can make losses. So that is why risk management is applicable under investment banking. And what do? Essentially, what risk management guys do is that every transaction done by treasury in a day, every transaction done by corporate finance guys in a day, you must involve the risk managers. They are like your voice of reason to tell you that, are you sure you're making the right decision? Are you sure you're taking the right steps? Have you considered this? Because sometimes the transaction can look rosy to you. You are not based on what the customer has said. Sometimes customers can hide information. They will only tell you the good parts. They will not tell you maybe they are having one issue or the other. It is your risk manager that will act as your, you know, when the Bible says one head can something, and then 2 heads, 1 head is like 10,000 and 2 heads is like 100,000 or 1,000, something like that. That's what risk management does. It protects the company's value by anticipating and mitigating potential threats. And as you will find out, for those of you that are going to go into investment banking full-time, you will realize that corporate finance and treasury guys don't necessarily always have the best relationship with risk management guys. They are always at loggerheads. They are always fighting because the treasury person will want to go ahead and do the transaction. The risk manager will say no. So it's almost like maybe you have a boss, right? And then it's like maybe 2 of you are siblings. two siblings reporting each other to their parents. It's something like that. So it's like treasury is one sibling, corporate finance is one sibling, investment banking is one sibling. They are always, risk management, they are always at loggerheads. But the idea behind risk management is that they work with treasury, they work with corporate finance to ensure that all the transactions they are doing are balanced. Let me put it that way. So if you've done some risky investments, they can tell you, you know what, this is the limits of the risk that we want to take. Any other thing you want to do, make sure that it is lower risk, right? I remember that in treasury, if you're on the FX desk, everybody has limits on the FX desk. It's like the limits are so detailed that maybe if I've only been an FX trader for 1 year, and there's someone else that's been an FX trader for 5 years, and another person has been an FX trader for 10 years, all of us will have different limits. Me that have done trading for only 1 year, I might have a limit of maybe $100,000. So any transaction I do must not exceed $100,000. Once there's a transaction that comes in that is more than $100,000, you have to send it to the person whose limit is maybe $1 million, for instance. You must not do that transaction. If you do that transaction and they find out, they can sack you. So we used to have individual trading limits, individual. Then FX desk has limits. Treasury has limits. In fact, there are some transactions that you will do in treasury, but you cannot do that transaction if the MD does not sign up on that transaction. Even the MD of the bank has limits for treasury transactions. So for instance, a transaction of 50 million comes in. You cannot do it without the MD knowing about it, even though the MD does not work in treasury. The MD is supervising the whole bank, but you cannot do that transaction without his knowledge. So they have limits like that. On fixed income, there are limits as well. We have traders limits. We have position limits. Position meaning that maybe at the end of each day, if you like, invest in, even if you have 100 things that you want to invest in, your position limit can be maybe 100 million. So that 100 million, it is you that will decide the different things you want to invest it in. But at the end of each day, you must not exceed that 100 million. There's position limits, there's trading limits, there are so many limits, liquidity limits. In fact, for ALM guys, the liquidity management guys, there's something we used to do where you have counterparty limits. So maybe if you are Zenith Bank, you must have counterparty limits for all the other banks. You must have a counterparty limit for Access, a counterparty limit for Unity Bank or Union Bank. And the idea is that you must do an assessment of all the other banks. Which ones are the tier 1 banks? Which ones are the tier 2 banks? Which ones are the tier 3 banks? So your counterparty limits for the tier 1 banks will be different from your counterparty limits for tier 2 and tier 3. So that, because under ALM, under liquidity management, for instance, maybe you as Zenith Bank, at the end of the day, you may have so much money. Maybe that day you got so much deposits, people brought deposits to the bank, you have so much money, and maybe at the end of the day, you have like 100 billion cash. that is not invested in any fixed income instruments or in FX or anything, you cannot just leave that money lying down in your account. You also want to make money on it, right? So the idea is that you will now start calling all the other banks to find out if they need money. We call it placements. So you do placements with them, overnight placements. It can be overnight placements, meaning you give them money today, they'll pay you maybe 15%. Tomorrow you get your money back. So that 15% is just for one day, right? It's usually calculated as 1/365. So it's not 1% flat. 1/365 times whatever the volume of the money is. So you get your interest the next day. When they give you your money back, they will also pay you 1 day interest. Some people, you can do 1 week placements with them. But the idea is that the amount of money you can place with First Bank or Access Bank, you cannot place that type of money with a mortgage bank or a microfinance bank, or maybe even a Keystone Bank, for instance. If you give First Bank 10 billion, maybe the highest you should do with Keystone, for instance, can be 2 billion. So there are all sorts of limits. All sorts of limits. But what is the idea? That the bank should not lose money, or as much as possible, not lose money. So that even if Keystone Bank goes under, you know that, okay, worst case, it is only 2 billion that you will lose. But you are almost certain that at least First Bank will not go under. So you can give them 10 billion. So that's the way risk management works. It's just to ensure that, you have a second opinion for everything you are doing. Before you take a decision, you must run it by somebody. They will also help you. Maybe the analysis you did not do, they can do the analysis, then they can now advise you. Okay, we'll do this transaction, or maybe try and ask the customer for this other information, or try and ask this customer for this extra documentation. They will just advise you like that. And then also, because traders can also be funny, like I explained to you earlier, there have been instances where traders did trades and they hid the trades, they made losses, they will not declare the losses because they are afraid. Then things will now get worse. So risk management is also to monitor the traders, monitor the people in treasury and the people in corporate finance, to be sure that they are not hiding anything. That's why then, up till now, at the end of the day, all the reports of all your transactions, everything you did every day, the reports of all the assets that the bank owns in treasury, maybe liquid assets, for instance, you must always send it to the risk guys every day. Every single day, you must send it to them. We'll send it to risk, we'll send it to the MD, we'll send it to the head of treasury, so that their job is to also look at it and ask questions and be sure that, the bank is not at risk or the company is not at risk. So that's the work of people in risk management, monitoring, valuing the risk, monitoring risk. They too, it is their job to also put their ears on the ground for global information, macroeconomic news, anything that can affect any investment, so that they can quickly also come and advise. So for risk management, it's almost like their own wealth management customer is the bank or that company. So they too must be monitoring the bank's assets to be sure that nothing goes wrong. So that's what risk management does. I hope you guys have learned something. I hope I did not bore you too much. So the last part I want to talk about before I conclude is Under the equity parts, I only talked about it from maybe corporate finance, helping customers raise capital and all of that. But remember, I talked about the secondary markets for equities. So you can also decide that you want to work with a stockbroking firm. Stockbrokers are also part of they are participants in the capital markets. So under the capital market, you have banks, you have corporate institutions, you have individuals, you have stockbroking firms, you have the Securities and Exchange Commission, that is the regulator, right? So under the capital markets, there's a secondary market for trading equities, just like there's a secondary market for trading treasury bonds and treasury bills. So you can also decide. I remember when I was going to start working, I had the option of either working with an equity company, a stockbroking firm, or the bank. And I chose to go with the bank. And for up till today, sometimes I wonder if it would have been better for me to have gone to this stockbroking firm. And the reason is because when you are a stockbroker and you know how to trade equities, you cannot be poor. Like, you can never be poor. And the reason is because it's just like a market trader. Trading is trading. Whether you have a shop in Balogun Market where you are trading maybe provisions or whatever, trading is trading. Trading is buying and selling. As long as you understand that product, the product that you are buying and selling, you cannot be poor. God forbid, the only way somebody in Balogun that knows how to do business very well, the only way they can be poor, maybe their shop gets bonds and they are not able to, they lose all their property, all their products, and they are not able to, maybe they don't have savings to start all over again. But other than that, if nothing happens to your business and you are very good in that business, you cannot be poor. So another opportunity in the market is being a stockbroker. You don't even have to be a certified stockbroker. All you need to do is to know how to trade. Download an app. There's so many apps right now. You can trade Nigerian stocks. You can trade US stocks. You can trade, there's so many instruments now. You can trade options. You can trade futures. There are so many products, but you need to have the skills and the knowledge. So as a way of, conclusion, I'm going to say that everything about investment banking requires knowledge, skills, the right mindsets. Like, learning in investment banking, the learning doesn't stop because there are always new innovations every day, new things to learn every day. So you have to keep building your financial knowledge even after you graduate from school. You have to develop your analytical and technical skills. Like, there's no two ways about it. You cannot run away from it. You have to know about valuation. You have to know about financial modeling. You have to know about problem solving. You have to be able to think outside the box. You have to be quick on your feet. You have to be the type of person that can think on your feet if you are an investment banker. Also, you need to grow your professional network. You need to, know people in the industry. You must have mentors. You must have, peers, useful peers, or peers that can give you information, because information is life in the investment banking space, right? Seek internships, certifications, volunteering, and leadership roles to boost your career prospects. You must stay curious, stay ambitious, and make the most of every opportunity. So thank you guys. Thank you. I hope I did justice to the presentation or to what investment banking is about. Yeah. So Mr. Inka, over to you.
Ah, wow. Wow. Learned so much within such a short time. Round of applause for our speaker, please. Thank you so much, Ma. Thank you so much. Thank you so much. Wow. Where do I even start from? We've learned right from the very nitty-gritty of what investment banking is. And one of the things I was so glad about in the training was to understand the various roles within the investment banking industry so that we don't just see investment banking as one big particular profession, right? So I'm very grateful to our speaker. I'm very grateful to our speaker, and thank you so much. Naturally, would give room to questions, but before I do that, I want to state a few things. I hope everybody on this call has filled the attendance form because the certificates for the training have to bear your names, and we have to be sure that the attendees that will get the certificates are those that attended the training. So if you haven't done that, kindly complete the attendance form so that we can then find your certificates, get them to you. Also, I heard some people within the chat are asking if they'll get the slides. I believe that you will be able to watch the recording. The link to the recording on YouTube will be, I'm sure it will be sent to you by mail, and any other manuals or information will be sent as well. So we have your emails, and we're going to keep the conversation open as there will be subsequent other trainings that you can learn from. So thank you very much. In the next thing, we would like to ask if you have questions. If anyone has questions for our speaker, now is the time she would like to take questions. So all you have to do is to raise your hands, and then we'll call you to ask your question. I'll start with my own question for the speaker. Okay, I have one question, but let me just use the power that I have by being the moderator of this session to ask my question first. Yes. Okay,
Right.
so yeah, so my question will be for those of us who finished school long time ago and we are somebody's laughing there. Okay, so I was who finished school long time ago and deciding that well, we would like to pursue a career in investment banking. What do you, one is, we want to ask, what will you advise? Two, remember we said we finished the school long time ago, so we are looking for the accelerated routes. So we don't want to go and read banking and finance all over again. That will take time. We want to make money in this economy, you know how things are. So what would you suggest for people like us that finished school long time ago?
Okay, so what I've picked up on, right, is what you want is to make money. It's not that you actually want to become an investment banker. You just want to make money. So for that, what you need to learn is, okay, what are the avenues through which you can make money in the capital markets? And one of which I've talked about is trading stocks. Trading stocks, there are so many people that teach the technique, the skills for stock trading and all of that. So if you're ready to learn, so and even apart from trading, you could just be an investor. You don't even have to be a trader of all of these things. So you can invest in treasury bills, you can invest in bonds, you can invest in stocks. There's a difference between investing and trading. Trading is you buy one stock today, sell it in 1 week's time, buy another one, sell, buy, sell, as maybe those stocks go into money. If you see a 10% income, you take it. If you see a 20% income, take it, buy something else. That's different. The people that invest, they invest for the purpose of dividends. So they just keep putting their money in different stocks that pay good dividends and they leave it there. And, and so on and so forth. So it really depends on the area where you want to focus on. Do you just want to be an investor? For that, all you need is a wealth manager to help you grow your wealth. But if you want to be an active participant, you want to learn trading skills, there are also ways you can learn. Thank you.
Thank you very much, Ma. So I would see to that I go and learn. Mr. Tunde, I believe that you have a question. You can go ahead with your question.
Good afternoon, moderator and the presenter. Thank you very much. My question is, we are in the era of artificial intelligence. I want to ask, what influence does artificial intelligence has on investment banking? And how can an investment banker benefit from this new innovation? Thank you.
So the role of AI or technology in investment banking is it just accelerates learning process, and it also accelerates or it helps with the work. So things like valuation, their AI can help you do valuation. AI can help you some calculations. AI can help you with information. So for instance, Bloomberg, there's something called Bloomberg, is a form of an information system. So if you have access to Bloomberg, everything about the financial markets all over the world, there's always news, any financial news on anything, both in Nigeria, abroad, everywhere. Bloomberg updates, news like per second. So peradventure, maybe you are a trader and your trading depends on news. You must have Bloomberg so that, like, I kid you not, the screen news is always flashing. Different news just keeps flashing in, like every second, every new information, it just drops. So peradventure, your work has to do with news. You will just be seeing everything. So you can quickly, make a decision. You are always aware of what is going on. So that's how AI helps. Also, even all these apps that I talked about, trading apps, everything is all AI. It just helps you to, for instance, you don't have to always go to the office before you can get information or before you can get your work done. You can get your work done at home if you have the app. If you are a stockbroker, for instance, it's not until you get to the office because in the capital market, for instance, the fixed income market, it opens by 10 a.m. every day and closes by 2. The stock market, I think it opens at 10 and closes at 2:30, I believe. So you don't have to be in the office before you can trade. If you have a trading system on your system, you can trade at home. Do you understand? So that's how that's in a simple way, that's how AI enhances investment banking processes.
Thank you, Ma. I also, so recently we have had some trials. So there are some versions of AI, generative AI and deductive AI that is now doing trades. So but that's still in the experimentation stage. So we don't advise to go and use your money to try it out yet. But what we have is that because AI can study past algorithms of trades and the consequences and things like that, they can look at market trends and historical trends, and they can then predict where and when to invest. So that is still in the experimentation stage. Perhaps soon we'll have one that can trade on its own and actually make money, but it is not going to replace human efforts. It's not going to replace human intuition and experience. But AI will work in the future. AI will work in tandem with you to be able to suggest trades based on, as we said, trends and things that are happening around the world, and we should make more informed decisions. So thank you very much, sir. Thanks for your question. We have some questions in the chat box. So one person says, thank you for the session, Ma. I'm a final year student studying accounting, and these are my questions. Okay, let me just read out our question. So sorry. Okay, so what are some misconceptions about investment banking that you think students should be aware of? So, background is she's a final year student studying accounting, and she's asked question one, what are some misconceptions about investment banking that they should be aware of? And secondly, for someone looking to transition from accounting to investment banking, what are the steps she should take?
Okay, the first question is very vague, right? Because misconceptions can be about the individual, right? Investment banking is just a space. So I'm not really sure what the misconceptions could be. But for the second question, it really doesn't matter if you are studying accounting. As a matter of fact, the fact that you are an accounting graduate, it puts you in a good place in investment banking, because I am assuming that you would already know how to analyze financial statements, right? So your knowledge of accounting is actually going to help you. You don't need to transition. You are already in this space. Accounting is also a valuable skill to have, or a valuable knowledge to have as an investment banker. So it is not only people that study banking and finance that have access to investment banking. Remember, I told you that, especially if you are going to start working in a bank, for instance, they don't really care what you study at the entry level. If you like, study food, study agric, they don't really care. Just come in and learn on the job. As a matter of fact, the reality is school knowledge, book knowledge, and working knowledge is not the same. So as much as the knowledge will help, the only way the knowledge will help you is if, for instance, you start working in maybe treasury today. When they're talking about interest rates, you are not lost because you already know what interest rates are. You're not like somebody that studied that Greek that may not quickly catch up on a conversation where they're talking about interest rates on inflation. So it gives you an edge. But anybody can actually do investment banking, even somebody whose first degree is not in investment banking. The important thing is that you are quick to learn. You are quick to learn, basically. That's what it is. It is at an experienced level. Maybe you are looking for a job as head of investment banking. that's where your specialization really matters. But as an accountant, you are already well positioned in investment banking. I think the better question to be asking is which area of investment banking should I focus on? But for that, I will need to know what you are good at. Are you good at analysis? Are you good at valuation? Are you good at relationship management? Are you good at do you have good communication skills? Do you have good presentation skills? It is those things that we can now use to decide, which area would be good for you. Some people are good in risk management. They don't have the heart to trade. They don't like taking risks. So instead, they would rather go and do risk management. So for the first question, I don't know, misconceptions. I honestly don't know how to approach that question. Thank you.
Thank you very much, Ma. We have one more question here. How do investment bankers assess the financial health and growth potential of a company before recommending a merger or acquisition, or even investment in the company? How do they determine the financial health and growth potential of a business?
So that's another entirely. It's not something that I can talk about now because it is not it's actually a whole other training, right? But on the surface of it, I would just say that you will need to know how to, again, do financial modeling, do valuations of companies. And by valuations of companies, what I mean is, in fact, it's not something I can talk like. You have to understand cash flow. You have to understand the nature of the business, the nature of the industry that the business plays in, because the nature of the business even determines cash flow. There are some companies that they never have cash, and it is not because they are not doing well. It is the nature of the business. While there are some other companies that every day they always have cash, it is the nature of the business. So you need to be able to also understand financial results. You can look at one company's financial results and you think they are not doing well, maybe because their cash flow statements, they don't have cash. Again, you need to be able to understand a company that is not doing well, not by reason of cash. Let me put it that way. There are so many, it entails so much. It's another training on its own. So maybe, Mr. Inka, what we should do is look at that as another day's training.
Yes, thank you, Ma. I was just about to suggest that. So thank you very, very much. So we look forward to that one as well. So once you get the information about that training, please register and stay ready. So any other questions before we call it a wrap today? Do you have any questions? Omar, do you have any questions for the class?
If it had been a physical one where I can see everybody's face, then so
Okay.
that's another
Can we,
one.
as many as we can we turn on our cameras so that our facilitator can see us? But while we do that, we have one question from Dija. One question from Dija's iPhone. That is what your name is here. So you are free to ask your question. Teacher that raised their hand, you ask your question. No, you are free. You are free to say it. Say the question. DJ, you can say the question. You don't have to type it.
Okay, so good morning. My question is, like, if I'm a year 3 student of banking and finance. So if one wants to become an investment banker, like after like finishing my degree, do I have to like go for a course again, or like I have to divert when I'm in year 4? Like I'm just asking, like, is there a particular course to go for again, like after I'm done with my degree? I don't know if you get the
I mean,
question.
yeah, I get the question. Of course, there are a lot of professional courses that you can do, but that doesn't stop you from starting, your career in investment banking. With your degree, you can start working at a stockbroking firm, for instance. You can start working in a bank, but in the bank, the only issue with working in the bank is that you may not really be able to decide that you want to work in investment banking. Sometimes they will just tell you this is the units where they are looking for people. So if you're not ready to work there, go. So, but if you are opportuned to find yourself in the investment banking arm of the bank, all well and good. There are lots of other places, asset management firms, investment banking, asset management firms are also part of the capital markets, stockbroking firms. There are a lot of some brokerage companies. Brokerage companies, they trade fixed income products. There are also some other companies that trade FX specifically, like they trade FX. I don't know how to explain it. They trade the G30 currencies. So euro against dollar, pounds against dollar, Japanese yen against dollar. They trade maybe crypto, So there are a lot of companies, not necessarily, it doesn't have to be a bank. So you can find, if you find yourself in any of those spaces, you are already working in investment banking. There are also some companies that do corporate finance. They focus solely on corporate finance transactions. If you find yourself working in any, so they are always doing structured deals, structured transactions. So I would say target companies that their names will tell you what they do. AfriInvest, some people call themselves something finance company, all of those places, even if it's a microfinance company, but if it is the treasury unit of the microfinance company, that's investment banking, right? So yeah. But in terms of the professional certifications, it would also depend on where you find yourself. So I may say wait till you start, working. Because if you're in treasury, for instance, then CFA, Certified Financial Analyst exam, may be more suited for you because it focuses on treasury, right? But if you're in the stockbroking part of the space, part of the investment space, you may want to do I think it's called something, Chartered Institute of Stockbrokers exam.
CIS.
Yeah, CIS. So there are different of those professional courses depending on the area where you are. If you want to do ACCA or ICANN, you can also do it because you will then learn about financial modeling, financial valuation, all of those things. So yeah, I would say wait and start working. But I mean, if it's taking longer than expected to get a job, then you can start any of those courses as well. No knowledge is lost.
Absolutely. Thank you very much, Ma. Thank you. Can we give a round of applause to our facilitator? Can those hands come up? Those claps come up. Thank you so much. Thank you, thank you, thank you, thank you, thank you, thank you, thank you. And so this brings our training to a close. I would like to thank everyone who turned up. Thank you very much. Thank you very much. I'm sure you learned a lot and which you will start applying immediately. And the final word from our speaker was that no knowledge is lost. So I believe that all we've gained today will bear immediate fruit in our lives. So thank you once again. Remember some of you who asked about the slides, you'll be able to watch the training again once the recording is shared. The link to the recording is shared on you for YouTube. So you'll be able to watch the training and see all that you may have missed or want to refer to in the future. So in closing, I would like to encourage you to continue to building an appetite for knowledge. Keep learning. Regardless of the age we are, whether you are old or you are young, we're in a season where we call it the information age. So the faster we can learn, absorb, and be able to apply knowledge, the better for us and the more fruitful we'll find ourselves. So please stay inquisitive, stay hungry for knowledge, and continue applying as much as you can. Open your eyes to opportunities. There are several opportunities you'll find. Don't feel you are too small or inexperienced to take the opportunities that are available. Use the internet profitably and be the best of you can be. And I'm sure that we'll hear good news about you very soon. So thank you once again. Thank you to our speaker. God bless you, Ma. And we'll see you guys at the next training. Thank you very much.